Fellow stackers for weeks, we've been watching the wrong battlefield. We tracked the banks, we dissected the Fed, we argued over derivatives, paper contracts, and financial tricks performed in New York and London. But while the spotlight stayed on the magicians, something far more dangerous entered the room unnoticed. Today, ignore the banks, ignore the Federal Reserve, ignore the paper trading floors, because the force reshaping silver does not wear a suit, it wears a lab coat. For 40 years, silver spot prices were set by paper promises. Contracts traded by suits who never intended to touch the metal. Air was bought, leverage was sold, but that era is ending, and it is not ending politely. The silver market is no longer driven by speculation. It is being driven by sheer necessity. A new buyer has appeared, and this buyer does not care about spot price. It does not care about charts. It only cares about survival. I'm talking about industrial giants in the East, companies whose factories shut down without silver, companies that cannot build batteries, chips, or tech if supply breaks, companies like Samsung. This is where the silver market changes character. When a hedge fund buys silver, it can sell tomorrow. When a bank buys silver, it wants profit. But when an industrial empire buys silver, that metal is consumed. It is fused into technology and removed from the market permanently. These are not weak hands. These are existential hands. What we are witnessing is not inflation hedging. It is not a simple trade. It is an industrial famine. And famines do not respond to paper price signals. They respond to survival. Silver is no longer just a financial asset. It is a strategic resource. If you analyze a strategic metal using old financial logic, you will miss what's coming. In the chapters ahead, we'll break down how this shift happened, why it accelerates into 2026, and why the biggest buyers on Earth are quietly vacuuming silver out of the system. Once you see this, you'll never look at silver the same way again. To understand why this pivot matters, you have to understand what died first. The old system didn't collapse overnight. It rotted. For decades, global industry lived under one fragile assumption: just in time. Inventory was treated as waste. Warehouses were liabilities. The goal was efficiency at all costs. Hold nothing. Buy tomorrow what you need tomorrow. It worked perfectly in a stable world, but stability ended in 2020. Supply chains snapped. Ports froze. Shipping costs exploded. What was supposed to be a temporary disruption became a structural failure. By 2022, just in time was no longer a strategy. It was a threat. And by 2026, it is being replaced by a far more aggressive doctrine, just in case. This is where silver enters the mix in a way most investors still don't understand. Silver isn't a luxury input. It's a bottleneck. Without it, production lines stop cold, phones don't ship, batteries don't charge, chips don't conduct. When executives realized this, they didn't hedge inflation. They panicked. But industrial panic looks different from retail panic. When you panic, you rush to a coin shop. When Samsung panics, they send lawyers, engineers, and geologists straight to the source. They don't buy ETFs. They don't trust exchanges. They go directly to the mines and sign long-term offtake agreements. 10 years. 100% of production. Metal locked before it ever reaches the market. This is the pivot most analysts missed. The silver market didn't tighten because investors bought more coins. It tightened because the metal never showed up in the first place. The river was diverted upstream, vaults drained, not because of selling, but because deliveries stopped. This creates a dangerous illusion. Spot prices look calm, charts look boring, but underneath availability is collapsing. Silver is being removed quietly, contract by contract, factory by factory, not for profit, for survival. This is why price no longer tells the truth. We are watching the slow death of a paper-rigged market and the rise of a physical one. And once that transition crosses a certain threshold, it doesn't reverse. It accelerates. This is where one concept becomes the center of everything inelastic demand. In most markets, price controls behavior. Higher prices reduce demand. Lower prices increase it. That logic works for investors and traders. It does not work for industries that cannot function without a specific metal. A hedge fund buys silver and sells when price drops. A trader panics on volatility. Those buyers disappear. But an industrial buyer plays a different game. If a company needs silver to keep a multi-billion-dollar factory running, price is irrelevant. $50, $100 or more, they still buy. The alternative is shutdown, lost contracts, and strategic failure. This is what turns silver into a choke point. Once demand becomes inelastic, rising prices do not reduce buying. They increase urgency. Every uptick confirms scarcity and forces buyers to secure supply faster before someone else does. This is also why the old narrative about bank manipulation is fading. Banks act for profit. They can flip positions. They can exit. An industrial buyer cannot. When industry buys silver, it does not sell. The metal is consumed, fused into products, and removed from the market permanently. Each ounce used is an ounce that never comes back. Over time, this creates a silent drain. Prices may look stable, but availability collapses underneath. Paper markets can delay price discovery, but they cannot create metal. Conductivity cannot be printed. A physical shortage eventually overwhelms financial illusion. As more buyers realize they are competing for a finite, irreplaceable resource, behavior changes. Hedging becomes hoarding. Efficiency becomes stockpiling. This psychological shift always precedes a violent repricing. And the force pushing silver across that threshold is no longer finance. It is government policy. Mandates written without regard for physics or geology. That collision is already forming, and it is about to accelerate everything. This shift does not accelerate naturally. It is being forced. And the force comes from government policy. Markets can ignore imbalances for years, but laws impose deadlines. As 2026 approaches, those deadlines are colliding with the physical limits of silver supply. Across Europe, China, and parts of the United States, green energy targets are no longer optional. They are legal mandates. Solar capacity must expand regardless of cost. Trillions of dollars are committed under the assumption that materials will appear when needed. That assumption is now breaking. For years, analysts claimed efficiency would save the system. Solar panels would use less silver over time. That trend has reversed. Physics set the limit. New high-efficiency solar technologies require more silver per panel, not less. Thicker silver layers are needed to extract marginal gains in output. Unlike financial demand, this silver is consumed. Once printed onto a panel, it is effectively removed from circulation for decades. It does not return to the market. That makes policy-driven demand uniquely dangerous in a market already facing inelastic buyers. Here is the contradiction. If silver prices remain suppressed, mining cannot expand. If mining cannot expand, supply fails. And without supply, green mandates fail. To meet their own laws, governments must accept higher silver prices. Suppression and compliance cannot coexist. This is why policy has become an accelerant. Not intentionally, but structurally. Mandates are forcing physical demand into a market that cannot respond with supply. The market remains calm because policy moves slowly. But once deadlines slip and installations stall, urgency replaces planning. And urgency combined with inelastic demand never resolves gently. Solar is only the first policy-driven wave. Behind it is technology driven by survival. That next wave is already locking up silver. While policy forces demand from one side, technology forces it from the other. Solar expands because governments mandate it. The next wave expands because industry cannot survive without it. That wave is solid-state batteries. Until recently, electric vehicles relied on lithium-ion chemistry. Silver played a minor role used mainly in electronics and connections. Solid-state batteries change that role completely. In this technology, silver is no longer optional. It is required for performance, stability, and fast charging. This is not a future concept. Pilot lines are operating now. Capital is already committed. Companies like Samsung are preparing to scale because solid-state batteries solve problems lithium-ion cannot. And solving those problems requires materials with unmatched conductivity. As silver use per vehicle increases, the impact compounds quickly. Tens of millions of batteries translate into massive new demand. And like solar, this demand is consumptive. Once silver enters a battery, it does not return to the market. This is where pressure converges. Solar demand is mandated by law. Battery demand is driven by survival. Both are inelastic. Both are expanding into a supply base that cannot respond. This is why industrial buyers act early. They understand that once solid-state batteries reach mass adoption, competition for silver intensifies sharply. Waiting means losing access. Here, silver crosses a line. It stops being treated as a traditional metal and starts being treated as a battery material. When that shift happens, price no longer controls demand. Availability does. Smart money wakes up, forcing industry to stack physical metal before the shelves go bare. This panic triggers the next phase: accessible silver vanishing from the COMEX and public float into deep private industrial storage vaults. Strategic stacking drives the market's biggest blind spot, the deep vault vacuum. While investors assume standard flows mine to refinery to COMEX to user, that supply chain is actually snapping. It is happening silently, but the fracture is now absolute and total. In past cycles, silver moved through public choke points, exchanges, vault reports, inventory data. That visibility created confidence. Today, industrial whales are bypassing those choke points entirely. They intercept silver at the very source. Miners are no longer selling into the open market. They pre-sell years of future output via direct private offtake agreements. When a tech titan signs these contracts, the silver never touches the COMEX. It never shows in registered stocks. It is refined privately and shipped directly to industry. On paper, global production looks fine. In reality, the accessible supply is shrinking fast and aggressively. This fosters a dangerous illusion. Analysts look at mining caps and assume availability. Traders see stable spot and assume balance. But the vaults show a different reality. Registered inventories drain while price remains tampered because the metal is removed before it ever arrives at the vaults. That is why lease rates spike. That is why deliveries stall out. That is why physical premiums decouple from spot. The public float is drying up. What's left is rehypothecated, promised, or already spoken for. And here is the kicker. This is not speculation. This is not a corner designed to squeeze profit. It is a defensive stance. Industry is locking up silver to avert disaster. Defensive stacking is far more dangerous than offensive speculation because it never unwinds back to the open market. When banks cornered markets in the past, they eventually sold. When industry corners supply, it consumes it. The metal disappears forever. That is the vacuum. And once enough supply bypasses public markets, paper claims begin stacking on top of a shrinking physical base. That imbalance does not resolve slowly, it resolves suddenly. And when it hits the only silver left to settle the market will be the silver no one ever planned on selling at all. Now we reach the wall everyone assumes will save the market supply. Surely miners can respond. Surely higher prices will bring new metal online. This belief is comforting. It is also wrong. Welcome to the supply cliff edge. Silver production cannot be turned on like a faucet. From discovery to first ounce, a new mine takes close to a decade. Permits, environmental reviews, financing, construction. Even if a major deposit were found today, it would not relieve shortages until the mid-2030s. Industry does not have that kind of time at all. Worse, most silver is not mined on purpose. The majority comes as a byproduct of copper, lead, and zinc operations. That means silver supply is tied to other markets that do not care about silver prices. If silver doubles, a copper miner does not suddenly double output. They follow copper economics, not silver scarcity constraints. Geology is also working against us. Ore grades are falling, mines are moving more rock to extract fewer ounces, energy, labor, water, and compliance costs are rising. In many regions, producers are barely breaking even. Low prices didn't just suppress investment, they totally hollowed out the pipeline. This is the hidden damage of decades of price distortion. Exploration budgets were cut, geologists left the industry, projects were shelved. The system consumed its seed corn. Now demand is vertical and supply is flat to declining fast. That creates a brutal reality. When demand overwhelms supply and supply cannot respond, price must rise until demand is destroyed. But we already established something critical: industrial demand cannot be destroyed by price. It can only be destroyed by physical shortage. So price doesn't ration factories. It rations investors, jewelers, and small buyers. Availability vanishes before demand does. Shelves empty. Premiums explode, the market fractures into paper quotes and real physical metal. This is how a slow imbalance becomes a crisis. And once the market accepts that supply cannot save it, behavior shifts from optimism to fear. That fear is what ignites the final blow-off phase. When fear replaces optimism, markets stop behaving smoothly. They gap, they seize, they reveal stress in places no chart can predict. This is the phase where paper and physical finally collide. For silver, that collision happens at settlement time. Paper markets function on confidence. Confidence that metal exists somewhere, confidence that delivery can be made if demanded. But when too much silver is locked away in private industrial vaults, confidence becomes fragile. Claims multiply while the underlying pool shrinks. At first, no one notices. Then one delivery is delayed, then another, then premiums rise without clear explanation. This is when the system starts rationing invisibly. Large buyers are prioritized. Small buyers are told to wait. Contracts roll forward instead of settling. Cash settlement becomes temporary policy. Each step looks reasonable in isolation. Together they signal severe stress. The most dangerous moment is when price no longer reflects availability. Spot quotes still print, screens still update. But real metal trades at a different level or not at all. This is when silver stops being a commodity and starts behaving like a rare controlled asset. We have seen this before in other markets: uranium, palladium, rhodium. When industry realizes it misjudged supply, price doesn't rise gradually. It jumps to wherever supply finally loosens. Not to a fair value. It goes to a clearing value. At that point, the narrative flips overnight. Media attention follows price, not fundamentals. Analysts scramble for explanations they ignored for years. The same voices that dismiss shortages begin warning of them way too late. This is also where investors make the biggest mistake. They wait for confirmation. But confirmation arrives with repricing. By the time shortages are acknowledged publicly, access is already totally gone. Silver is approaching this inflection, not because of panic, but because preparation has already happened quietly. The metal has moved, ownership has shifted, the float has shrunk significantly. And when markets realize the silver they assumed was available is not actually for sale, the adjustment won't ask permission. It will just force it. At this stage, the question is no longer whether silver is undervalued. The question is who will be left holding it when the market finally admits the truth. Because when a strategic material breaks from its financial past ownership, matters far more than price. History offers clear parallels. When palladium ran short, automakers didn't negotiate. They paid whatever was required. When rhodium vanished, price didn't discover value. It exploded until demand was forced to adapt. Silver is larger, more essential, and far more underestimated than either of those metals ever were now. What makes this moment unique is the convergence. Solar mandates, electric vehicles, advanced batteries, defense systems, digital infrastructure, all drawing from the same finite pool, and all competing under legal, industrial, or strategic pressure. This is not cyclical demand. It is truly structural. Banks understand this now. That is why positioning changed. You do not short a famine, you secure supply. Institutional behavior always shifts before narratives do. By the time consensus forms, positioning is already fully done. The retail investor sits in an unusual place. Too small to influence price, but early enough to still access metal. That window is rare. It closes quietly, then suddenly, not with a crash, but with a big sold-out sign. This is the uncomfortable truth price will not warn you. Availability will. The first signal is not a spike on a chart. It is a delay, a limit, a higher premium, a dealer with nothing to offer you. When that happens, psychology flips. People don't ask if silver is a good investment. They ask where to find it. That is when markets detach from logic and move on sheer urgency. We are approaching that moment, not in theory, in structure. The demand is locked, the supply is constrained, the paper market is stretched. All that remains is mass recognition. And recognition always arrives way too late. This is where everything comes together. When you strip away the noise, the charts, the opinions, and the distractions, the silver market reduces to one simple truth. A strategic metal is being consumed faster than it can be replaced. That is not a trade. That is a structural reset now. Silver is no longer waiting for investor sentiment to turn bullish. It is being pulled forward by industry, by law, and by physics. Solar mandates are locked in. Battery factories are being built. Supply pipelines are depleted. And the metal that once flowed freely through financial markets is being locked behind factory walls now. The lesson here is not about timing tops or bottoms. It is about understanding role changes. When a material shifts from optional to essential, price becomes a secondary concern. Access becomes everything. This is why the biggest players are not trading silver. They are securing it all. For investors, the mistake is overthinking, waiting for perfect confirmation, waiting for headlines, waiting for price to prove the thesis. By the time silver proves anything, it will already be gone from shelves and vaults forever. The opportunity is not infinite upside. The opportunity is asymmetry. Right now, silver is still treated like a financial asset priced like yesterday's metal while being consumed like tomorrow's fuel. That disconnect